All right, man. January's here.
Yep.
Time to talk about taxes, right?
Yeah, already, man. It's never too early to start, for sure.
Yeah. You guys out there are probably like, what in the world are you talking about? January taxes? That's not till April, or that's not till mid-year. And I'll say totally the opposite. January's the time to start thinking about taxes with strategies, et cetera. That's not what we're talking about today. But really what we want to talk about today is, let's call it a cash flow bucket system, if you will, right? On what you need to start doing internally at your dental practice to prepare for taxes. And I'll throw it to you, Bill, here. Just, we've heard of profit first, right?
Yeah.
Everybody out there's probably heard of profit first. I'll get your opinion, but to me, it's a little complex on all the different bank accounts and things, I guess, you set up and where you transfer money and all that sort of thing. I think today that's a little complicated, but if we keep it simple, maybe just talk about maybe an operating account and a tax account at first. But what's your feedback there?
I think Profit First is really more designed for people who have behavioral issues towards money. I mean, that sounds terrible to say, but if you struggle with that and you struggle with spending money that you know you shouldn't, then I think Profit First is a good solution. It's just complex, and it takes a lot on a business. It takes a lot of moving money around and a lot of different accounts. And it, in my mind, I agree. It creates complexity where there doesn't necessarily have to be. So I think we've kind of over time just developed a Profit First light. It's not really as much designed for behavioral problems. I mean, that's a deeper problem. It's really more designed so that you don't have surprises specific to tax at the end of the year. So, yeah, I think really those two accounts, Jared, the operating and tax accounts, are a really good place for most people to start.
Yeah, agreed. Let's hit on the operating account, right? All right, so you got that operating account. That's where everything's going in and out of. Let's hit on real fast, like what we recommend on I'll say minimum threshold we think you need to keep in that operating account.
Yeah, so I like 10%. And I admittedly get bashed on this sometimes that's too high. But I think in today's environment, I think we're hearing a lot of people say they have some concerns about the economy, about people spending. When I hear that, I think you should have what we call a fortress balance sheet. And for dental practice, that means have plenty of cash. I personally like the 10% of your expected collections number is what you'd like to have in unencumbered cash. And that means it's net of your tax cash. So this is pure operating cash.
Yeah, so expected collections, right? So here, January 2026, I've got a practice bill. Not really, but you guys' example, I got a practice. I think I'm going to do about $1 million this year in annual collections. You're saying 10% of that, 100 grand.
Let's put 100 grand in operating cash that just sits there.
Yeah, and you guys might hear that right now and like, holy crap, like 100 grand? I never keep 100 grand in there. I keep like 40 grand. Well, you probably stress a little bit about cash flow, right?
You could, and really it's designed to say we don't want stress of knowing you're either going to have to put money in that may not be there, borrow. It just gives you a bit of a cushion. Usually with well-run practices, it equates to about a month and a half of expenses. That's a nice little nest egg to have if something were to happen. It just gives you peace of mind. I think it's a good goal. For some people, it's aspirational goal, but to me, it's worth exploring. Could you possibly get to 10% unencumbered cash that's sitting there? And then after that, you can distribute down to it all you want. Just keep that baseline in there. Once you get to it, I've had clients that argued with me that they could never get there. And once they do, they love it. And they kind of have a floor that they sweep down to, but at the same time, they always know they've got the basics covered. And that's a good feeling.
Yeah, and they sleep better at night too.
100%.
Yeah. Okay, so you got an operating account. We got 100 grand in there. Now let's talk about the tax account, right? So what's that tax account look like in the practice?
So really assuming that you don't have a robust cash management system where you can look at internal escrows, it's not overly complicated to set up a separate cash account that is your tax account. And what we recommend is each month you sweep a certain amount over into that tax account, and that amount can vary. You know, some people are very conservative and use like the uppermost tax rate they could possibly be in. Other people really want to dial that into kind of what their effective rate is. This is something we would say, talk to your CPA. Ask them, like, if I were to sweep money monthly to try to account for my taxes, what would that look like? And what you'll find is that as you get in a habit of doing that, yes, it kind of sets you back on your operating cash account. But what you don't have is these really big splashes in, say, April and June, September, when all of a sudden they're like, okay, I need you to write a check for $30K. Well, that all of a sudden throws you completely off the loop, off your game. But if you had been setting that money aside, then you have it accounted for. It's not part of your operating cash, and you write the check, and you just feel, generally speaking, I think you'd feel better about that knowing that you've accounted for it. And here's the beautiful thing. You couple that with tax planning, Jared. Maybe you set a certain amount back. Well, maybe you don't need it all.
There we go.
Well, then you distribute it to yourself anyway, and then you have some free cash flow personally that you can do with because you've done tax planning to try to minimize that liability. So it goes hand in hand. Your operations to generate operating cash, set back money for taxes, tax plan to try to get that balance down as low as possible, pay whatever tax you have to, and whatever residual you have in both your operating and your tax account. That could be your personal money that you invest or do whatever you want.
Yeah, exactly. So let's get tactical here, right? You get through January this year. First off, set up that account this year.
Yep.
I like what you just said, a separate bank account.
Yeah.
It looks different on the balance sheet. It is in a separate bank account.
Right.
There's a transfer. I like that. A lot of people might keep it in one and you internal escrow or whatever. I don't like it. Keep it separate, right? But you get through January. We're here at the beginning of February, give or take. February 10th, February 15th, books are closed. You're looking at your P&L, what that taxable income is off the practice. You got a rate you're setting against that. Let's just use an amount, Bill. I'll say 30% to be easy. 30% that you put against that net income, then you slide that money aside and put it in that tax account and escrow it going forward every single month.
Talk to your CPA. I mean, they'll be thrilled. I promise you they will be thrilled to hear that you're being proactive and accounting for the cash needed for your taxes. Get them involved. Get them excited to try to minimize that balance that you owe and keep as much of it as you can. But, just slide it over, put it in that column, and that's sleep at night kind of stuff because, again, that's where businesses can get in trouble is these unexpected big cash outlays, and taxes one of the biggest ones that can happen if you don't watch out.
Yeah. Well, the other thing, I think I've said this in other videos, but let's say you don't do this, right? A lot of dental practice owners operate off the bank account.
Yep.
That's just all there is to it. And they see that bank account going up, up, and up, January, February, March, April, and they're like, man, I'm doing good.
Yep.
Like they're not setting money aside for taxes. It's all in one. And then they come June or whatever, and they're meeting with their CPA, and they're looking at the first half of the year, and the CPA is like, man, you're doing good.
Yeah.
Guess what? You're going to have to pay in some estimates here. You're doing better than we thought. And now that operating account that has your tax money in there, if you will, that you thought you were doing good off of, gets drained down, maybe below that threshold, that 10%. Right. And you're like, well, crap, it's just that gut punch that just hit you. And if you were to account for that throughout the year, it's all about expectations. You would have been like, okay, I'm doing good, but I'm setting money aside. And it's not that gut punch that you would feel.
Let's go even worst case scenario, which is you go the whole year accumulating cash. You feel like you've done really well. You got excess cash. You distribute all yourself. You pay down debt or you buy something or whatever. And then all of a sudden, April the following year, or May or June, July, August, whatever, now you owe $60K. You don't got it. It's gone. This is just a proactive way to make sure that you don't get blindsided. Because typically most people we work with and most dentists out there, I would venture to guess that 80 to 90% of your tax is going to come from your practice.
For sure, yeah.
And so if you can account for the taxes out of that, very rarely you're going to find other surprises unless you have a lot of different stuff going on outside of it.
Right.
So just understand that. Most of your tax is derived from your practice, and if you can account for it proactively, there's just no surprises. And to me, you and I are business owners. We don't want surprises. Cash, when it comes to cash, that's the last thing you want. Just a super simple method to try to set some money back, make sure you're covered there, and then you look at that operating cash and consider it unencumbered. That's important.
Yeah, and I love what you said too is hopefully, right, you're setting that money aside at a conservative amount, and then come quarter end or whenever you're meeting with your CPA, utilizing tax strategies as well, you've got excess funds.
Yeah, that's right.
In that cash account. See the total opposite of what can happen?
Yeah.
Meaning you don't do this, you get to year end, never talk to your CPA, they say you owe 100 grand or whatever, you get the cold sweats and, oh my gosh, my whole year just went down the drain. I thought I was doing good, right? That's one end of the spectrum. The opposite end of the spectrum is you're setting money aside monthly, paying it in quarterly, doing tax planning, implementing tax strategies into the year. You have excess money in that cash account. That's just a Christmas present.
And you built up that 10%, you're in a spot that almost any business owner out there would trade in a heartbeat.
100%.
It's a great spot to be if you can 100%. Have your 10% and have your taxes accounted for.
Yeah, I love it. There's no downside to doing this. No downside. Go to your banker, say, hey, I want to set up another account, make there be able to be transfers between the operating and the tax account. Start doing it now. You guys are watching this in January. Do not say, well, I'll do that in July.
You won't do it.
Exactly. It won't do it in July. Do it now. Do it in January. Do the first transfer in February. Set this year up on a good spot for tax purposes. All right. Love it, Bill.
Got it, man.